Welcome to Subramani. Please click the bell icon so that you are informed about which are the videos which are going to be released soon. And please subscribe to the channel if you have not yet subscribed. Right. So today I'm going to give a lecture, and I'm preparing for that lecture. And one of the things that I wanted to talk about is what are the impediments which are there, which you might encounter while in the wealth creation journey. So please bear with me, there are many points. So the first and the biggest wealth destroyer is if your family has never invested in equities. Chances are, and they don't understand equities, obviously, therefore they have not invested in equities. It takes tremendous amount of effort for you to be able to tell them why the market goes down, market goes up and all that. So please rope them in and tell them a small portion of your money will go into creating wealth, and for that you have to put money in equities and then start investing, because interrupting compounding is one amazing way of destroying wealth. So what are the main reasons why people don't create wealth or have not been able to create wealth? You can see such people around you. So first is the poor investment choices, chasing high returns without doing any research. Why will you get high returns just because you need it, right? So don't get into these get rich quick and chit funds, or forget chit funds. There are so many saying, they show you the face of a celebrity using AI and say, I'm going to give you tips, I'm going to give you a call on Nifty. There are so many people who have been impersonated. I've seen those videos, I've marked them, and I said, look, this is happening. Not that they can do anything about it. They also have to just complain to YouTube or somebody in social media, maybe to Twitter, but it doesn't really help. None of them are interested in hearing what you are doing. So be careful about whom you follow, what you do. The Sahara scheme for chit funds defrauded millions of investors, right? And another thing, don't think it is only 5,000 rupees, because 5,000 rupees at the age of 22 looks small maybe to you. Maybe you're running 1 lakh a month, so 5,000 looks small, but think of this 5,000 becoming about 3.5 lakhs by the time you are 65. At 65, that 3.5 lakhs could be more useful than this 5,000. So don't say only 5,000 or only 500. Give it time. Over 30-40 years, that comes up to be a very big amount. Another thing which I see is people playing Dream 11 and overtrading in stock markets obviously through derivatives, F&O, because there's no money to take delivery. So you want to take big position, you want to put 10,000 of your own money and get a 20x exposure. Happens only with F&O. Therefore, people do F&O without understanding what it means. A recent case of Jane Street is proof that if Jane Street has to make say 1,000 crores, from where is it coming? It is coming from lakhs of investors losing 1 lakh, right? So lakhs of investors losing 1 lakh leads to thousands of crores of profit for a company like a Jane Street, and there are many like that. And the regulator can't really help. So the best way for you is not to speculate, not to do F&O without understanding what you're doing, right? So to say it is only 5,000, only 10,000 makes no sense. The power of compounding, you will realize how big it is. Another mistake which I see people do is not saving enough, but saying, oh, I don't have money to save, but they have 49 rupees, 50 rupees to lose on Dream 11 every day. And then they sit and discuss. It's a big thing. So how much did you earn today? Oh, I invested 49 and I got back got back 49. So you didn't make any money, but didn't lose money. But largely the rule is people will lose money. Dream 11 is a very profitable company, right? So now, which means the saving is less. So that is another impediment to wealth creation. Next is lack of diversification. Those who think, those who have made some money in equity, they started an SIP, put 5,000 rupees, end of the year, they thought they'll get 60, they got 75. They got sensationally great return, because in a small amount to earn 15,000 rupees was fantastic. Now they think every rupee should only be in equities, which is not true. So one big impediment to wealth creation is lack of diversification for people who don't understand. Now if I understand and I have a surplus and and I know that the market will recover in 5 years, it is different. But for somebody who's got that limitation that I need this money in the next 2 years, so next year if I don't get, I'll get more desperate. So that amount of money should not be there in equity. That should be there in debt. If it's comfortable, if you need money today, the market is booming and you want to spend on something and you don't want to use your debt portion, that's fantastic. Take withdrawing money from equity in a position of strength you can do, but that's for a later time. But lack of diversification, over investing in a single asset class, which could be real estate, it could be equity, or it could be gold. It's very common. Equity is not so common because people with lot of money in equity also have their own house and also have some gold, SGBs, etc. So over investing in equities also could happen, but it's not common. More common is investing in real estate, saying, oh, I have real estate here, I have real estate in Hyderabad, I have real estate in Bangalore, I have real estate in Pune. Why did you do? Because I changed jobs. So they have real estate all over. So concentrated portfolios with real estate is not impossible to find, and I find them quite regularly. And say, oh, I bought something in NCR that has appreciated, I bought something in Panvel that has appreciated. Great, but not diversifying across equities, bond, gold, and other portfolios will hurt rather. High debt and lifestyle inflation. I need not have spoken about this 20 years back, because people were not borrowing to spend. Largely people were borrowing to buy a house or buy a car, right? I'm against borrowing, but yeah, the only borrowing which is still okay is borrowing for education, which means you are still borrowing for expenses. And second is to buy. The only asset for which you should be borrowing is buying a house, because the builders have made sure that the houses are out of reach for most of us without borrowing, right? So the RBI study shows that 55% of borrowing today is for spending, not for investing. This is an EMI trap you're getting into. People think of everything as EMI, so whether it is taking your family to for a vacation, or whether it is buying a car, or whether it is even repairing a car, right? Everything they need on a basis of quick fix. I need the money today, I need the fix, I don't get it, I'll borrow and I spend it, right? So that's what happens. Another thing which is unbelievable, even among chartered accountants, I find lack of investing taxation knowledge. So investing in a child's name makes sense, because you're going to withdraw when the child is 18 and there is going to be no clubbing. Keeping your money in your parents' name makes sense, because the income is going to be generated for them and they are going to spend it. You are spending some money on your parents, but you can do this by creating I mean, sorry, I'm digressing, but one of the impediments to wealth creation is neglecting inflation and taxes. You cannot neglect both. So you think you got fantastic return, you got 24% return, but if it has been eroded with an 18% inflation, you still have made money. But look at inflation also when you're looking at returns. Look at a real return, not just at the number. Another thing is panic selling, right? Emotional decision making of panic selling. Oh my God, there is COVID, the world is going to come to an end. So you sold in the month of March, and you've had the fate or whatever of seeing it in September, saying, oh, my money could have doubled, right? So during market crashes, many investors would sell their mutual funds, redeem their mutual funds, or sell equity and then regret. So again, herd mentality, saying, oh, everybody is selling, and you will hear very noisy. Are you still in the market? The market has already fallen 20%. It's a great, fantastic sign to be buying and not a sign to be selling. What the anchor says doesn't matter. Anchors don't understand. Anchors read what somebody else has written for them. Be careful about that. Inadequate insurance and emergency funds. You should never ever have to sell your equity in a position of distress. Oh, my mother is in hospital. You're asking me not to sell your mutual funds or your equity? Yes. You should have had medical insurance for your mother. You should have had medical insurance for yourself. So not having medical insurance, or not having emergency funds, because you don't have emergency funds in a bad market, you need money, you withdraw from your equity funds. What will you do? Because of, again, I spoke about earlier, lack of diversification of your portfolio and not keeping money for your your own requirements, right? Some emergency which you need, and you have to sell equity in a bad market. Well, bad luck. Schemes and frauds, Ponzi schemes, fraudulent schemes. I mean, the Rose Valley scam in West Bengal duped 17,000 crores. Repeat, 17,000 crores, and I think this scam is at least 10 years old. So if this money were in an index fund today, it would be 35,000, 40,000 crores. Not a small amount of money, right? But well, these frauds are quite common, happens regularly, people don't bother, and then after some time another scam happens. So saving yourself from Ponzi schemes and phishing schemes and online frauds, just have a look, just have a look at all this. Of course, then there is procrastination and not starting early. Delaying investments reduces the power of compounding. For example, a 25-year-old investment, 5,000 in a mutual fund at 12% would accumulate 4.8 crores. But if you started at 60, it will yield only 1.3 crores, right? So harness the power of compounding, which means harness the power of time. Not doing it impedes your wealth creation. Many Indians will I mean, everybody prioritizes child's marriage or child's education over their own retirement, right? That's a horrible example to give. India specifically, certain things happens like spending heavily on weddings, spending on jewelry which people may or may not use, you may lose, right? So investing in gold is different from investing in jewelry. Gold prices may be stable, it may sometimes outpace inflation, sometimes not outpace inflation. There is going to be a lot of job market volatility, so that could be another impediment. Of course, then there is regulatory risk. After you invest, if they make some changes regarding taxation, etc., you can't do anything. How do you avoid these kind of wealth destroyers? First is educate yourself. Learn about learn about the importance of personal finance. The CA course, the LLB course, the medicine course, nobody is going to teach you these things. These things have to be learnt on your own. Diversify your investments, spread across maybe mutual funds, put some money in PPF, gold, blue chip, SGB, whatever. Consider SIPs in index for steady growth. Also understand that SGBs are available today. Don't comment in the comment that, oh, SGB subscriptions shop. Yes, government is not taking, but it's available in the market. Avoid scams. Verify investment platforms with SEBI or RBI before investing. Check whether their registration number is valid, right? Of course, start early because leveraging the compounding, to leverage the power of compounding, you need to start early. And the longer that you stay and the less that you interfere with the compounding, the better it is for you. Stay disciplined, avoid emotional trading, stick to a financial plan, and consult certified people who are there, obviously for a fee, and then do your trades, right? By addressing these wealth destroyers, all of us can build sustainable wealth despite our, economic, cultural challenges which you are coming from, right? Thank you.